am John Kaiser at the Metals Investor Forum in Vancouver. It is January 18th, 2020. I am talking to Martin Turenne, CEO of FPX Nickel. Martin, welcome to Vancouver.
Thanks, John. Appreciate it.
Martin, your flagship project is Decar. It's a very low-grade nickel deposit. In fact, so low-grade and billions of tons of this that most people just laugh and say, you know, what are you guys smoking? And yet, this is a very significant play. What is special about the Decar deposit?
Yeah, so there's certainly a saying in these circles that grade is king, and our view is that margin is king. And margin is a function of mining costs and processing costs primarily. And in our case, the nickel is hosted in a mineral called awarenite, which leads to a very simple metallurgical process of magnetic separation and flotation to produce a very high value product using a very cheap and simple process. From a mining standpoint, we deal with a very low strip ratio. The strip ratio here is 0.17 to 1, which means that almost everything you mine goes into the mill. And so as a function of easy, simple metallurgy, easy, low cost mining with a low strip ratio, this can still be a very low cost producer in much the same way that porphyry copper deposits can be low grade but still be very high margin.
Now, Cliffs recognized this and they became a farm-in partner around 2009 or 10, and they spent $22 million on this project. But at the same time, there was concern, if this is something nobody has ever looked at before, how many of these multi-billion ton blobs are there in the world? And FPX, called First Point at the time, initiated a global program to research where other such projects are. And in fact, you found other potentially similar projects in the Yukon and British Columbia. After all this work, what was the upshot? Is Decar fairly unique, or is there a danger that many other such deposits remain to be found and exploited in this sort of simple magnetic separation method?
Yeah, well, we think that there are certainly the opportunity for more of these types of deposits to be defined globally. Basically, anywhere where you have large ophiolite belts, of which there are many around the world, we think that these types of deposits can be uncovered. Both are, we were certainly the leaders at that time in doing that exploration, as you mentioned. And frankly, there were some countries that we thought were highly prospective where we may not want to actually go and do exploration, places like Iran and Russia. And also other countries that are actually more amenable to mining, but where it's perhaps more difficult to get exploration permits, places like Turkey, for example. At the time we were doing that exploration, you also had companies like Altius also looking for this style of awarenite nickel mineralization. And as we continue to advance Decar and demonstrate that it can be a highly robust and highly economic deposit, we think we'll see another wave of exploration by other companies looking for this style of nickel.
Mm-hmm. But in 2013, after Cliffs delivered a PEA, it seemed to require a nickel price north of $9 per pound. And then meanwhile, nickel sank as low as $4.50. It's recovered back to sort of $6.50 a pound. You eventually reacquired the 100% in 2015. What have you done since then to improve the economics of this project?
Yeah, that's really the fundamental question here. We think that our market cap today, around 25 million, reflects a project that is assumed to need $9 or $10 a pound to be feasible. So our focus has been on optimizing every aspect of the project. We've really re-engineered the project from the ground up. We did step-out drilling to expand the higher grade portion of the deposit. We have revised the flow sheet such that we're obtaining much higher recoveries towards a much higher value product. We've done market testing with downstream users to enhance our understanding of payability, which we think will be significantly higher than what was previously assumed. In the meantime, the Canadian dollar has weakened considerably, which also helps our project from a cost standpoint. And so when you bake all of those things together, we've been working on internal trade-off studies that suggest to us that the project, rather than requiring that $10 a pound nickel to be feasible, is going to be feasible at a much, much lower nickel price. And ultimately, that's something we think we can put in an updated PEA so that everyone can understand those optimizations and what it means to the bottom line.
Mm-hmm. Now, your product is interesting in that it doesn't need to be refined. You're producing a 65% nickel concentrate, which you hope to sell to steel mills that they can feed in directly into their furnaces to make stainless steel. But a couple of weeks ago, you put out an announcement on a study you did about the possibility of making nickel sulfate from this concentrate. What is the strategic importance of that announcement?
Yeah, so we've got an ore body here at Decar that's going to support a 35-year mine life and be one of the largest nickel mines in the world in terms of annual production. And as you mentioned, feed a product to the stainless business that is a high-value product that doesn't need to be smelted and can go directly into the end use and achieve a very high payable. The testing that we've recently done with Sherritt is to show that we can take that same concentrate and it will leach very easily, very simply into a nickel solution that would be suitable for feeding into the EV battery market. And so the strategic importance here is to ultimately to expand the number of potential markets and customers that whoever operates this mine can sell into. And as from a mining company standpoint, the more markets you can sell into, the more customers you have, the more pricing power that gives you. And if we live in a world where you and I and everyone else is driving an EV in 5, 10, 15, or 20 years' time, this ore body can help to meet that need, that demand need for nickel sulfate. And we think that the pricing of that product will be at such a premium to generate even better economics than it might just selling it to the stainless market.
Mm-hmm. So you've done all this work. It looks like it's improved things a lot. You're ready to do an updated PEA, but what's the trigger to initiating this process? And when that trigger happens, how long would it take for us to see what the new economic parameters are of all the work resulting from all the work you've done?
Yeah, I would say the trigger is imminent. It really comes down to a final board decision, and we think that we could be in a position to have that trigger, be announced in the coming days and weeks. And we think we view as sort of a 6 to 8 month process to bringing a PEA to the market. So likely by sort of Q3 or Q4 of 2020 is where people can start to think about seeing that updated study.
So you're happy with where nickel prices are already and the outlook for it. So it sounds like it's more a board decision than waiting for, say, nickel to crank back through $7 a pound.
That's correct. Yeah, we think we can produce nickel at a low enough cost that the project is very robust at even a modest nickel price assumption.
Now, if you make this announcement, the market will look very favorably. They'll know you already have your internal scoping study. They know you're not going to be wasting your time preparing an updated PEA. So we may see repricing of the stock rather than this like hopeless thing needs $9 or better, which probably will never happen for nickel, at least not on a long-term basis. And market interest increases, your stock price goes up, funding becomes available. You don't need a lot of funding right now to take it to the pre-feasibility stage, which is next you got to do the PEA first. But people want to finance you. What else can you work on during 2020 that changes the fundamentals of the company?
Yeah, well, we could continue to do some refinements on metallurgical optimization for producing products either for the steel or the stainless steel or the battery market. Beyond that, one of the things that we've had our focus on for several years is another target at our deposit. So our land package covers 245 square kilometers, and only a very small proportion of that has ever been explored for. We've defined a target called the Van target within the same land package, which has a larger lateral footprint than the deposit, which we call Baptiste. And the grades at surface at the new Van target are significantly higher than the grades at surface at Baptiste. So it suggests to us that Baptiste on its own is a multi-generational deposit that could support a very long mine life. We think the Van target is highly prospective for delineation of a second multi-generational nickel deposit. And so putting some holes into that to see what we have there is something that's certainly of interest to us. Whether we do it this year or in coming years, that remains to be seen.
So this is a potential additional discovery, and given that 400-meter centers seem sufficient to delineate this very consistent homogeneous type of system, you could be delivering maybe another 500 million to billion ton blob of better nickel grades. is it possible to substitute that for Baptiste if, say, you accomplish this year after around the same time as you've delivered the PEA for the Baptiste zone?
For Baptiste. Listen, Baptiste is a world-class ore body, and we're not aware of ore bodies in the nickel space that are more economic or that work at a lower nickel price at that scale anywhere in the world. The Van target, if it's shown to be larger and or higher grade, maybe that becomes a more attractive deposit to develop first. But for the time being, Baptiste is plenty economic on its own. And we look at the Van target as sort of tantalizing upside to demonstrate we might have, another, significant scale and highly economic deposit within the land package.
Mm-hmm. One of the interesting things that intrigues me about the Decar project is that your team thinks it could become a carbon neutral mine. Why is that, and what is being done to verify that possibility?
Yeah, so our deposit and really any belt of ultramafic rocks, typically you will find the presence of a mineral called brucite. Now, brucite is not of any economic interest. However, when brucite has gone through the process of mineral processing and has been ground to a particle size that allows it to be exposed to the atmosphere, brucite will actually capture CO2 and react with CO2 and form a carbonate mineral that locks away the CO2 really for eternity. And so we've been funding research work at UBC over the last several years alongside De Beers, the diamond mining company, to better understand this style of mineralization and to better understand the ability for these types of mines, including Baptiste and the Gaucho Quay diamond mine in the Northwest Territories, which is owned by De Beers, such that the brucite and the capture of CO2 affected in tailings could more than offset the carbon footprint of operating the mine, so that these mines could ultimately be shown to be not just carbon neutral but carbon negative, which would be really a fundamental breakthrough for the mining industry.
That's interesting. That's certainly an attractive feature for post-boomers, people born after 1964 who are going to be around to experience the consequences of climate change, whereas unfortunately people like me most likely will not be around for that. I've been talking to Martin Turenne in Vancouver at the Metals Investor Forum. Thank you, Martin.
Thanks, John.